Hey guys, so I've said a few times that I've made some adjustments to my long-term ETFs and stock pies. So I thought I would do an update to those this week. So split it up into one video for the ETFs and one for the stocks. So this is the new ETF pie. I've sort of done it on the on Excel for a couple of reasons, really. Three of these funds aren't available fractionally on Trading 212, so they're not available to go in the pie, so it just makes it a little bit more complicated to have three of these outside the pie, and the weightings are then wrong. And also because I'll be having these in the ISA and the invest account, so again, sort of not really easy to put in the pie. I'm not going to have the pie in both accounts. It just complicates things. So I'll just have them as individual investments and update them with the spreadsheet. So yeah, so been having a bit of a change towards mid cap and small cap stocks, wanting to sort of include the total market basically in the ETFs. Basically sort of seeing the mid cap sort of stocks tend to outperform the large caps over the long term. If you look sort of recently, things like the S&P 500 have outperformed, but it's only really sort of very recently in terms of long-term investments. If you go back sort of the last century, in the good times, the mid caps tend to have a slightly better time of things, and the small caps sort of an even better time, really. So with the US side over here, I've gone for 10% S&P 500, 7.5% for the S&P mid cap index, and 7.5% for the US small cap value side. So I've gone for small cap value rather than just small cap, because a lot of the research seems to sort of show basically that the sort of growth stocks in the small cap index, a lot of them seem to sort of fail, or generally be not very profitable. So they sort of get weeded out basically by the time the ones that do sort of be successful, they would make it into the mid cap index, and you would sort of see the growth in them in there. Where if you just have the value side in the small cap index, then you're not having those companies that basically go bust, or just sort of don't do that well in the small cap index. So you're sort of having the best side of the small caps and all of the mid caps. So the weightings here would be a sort of maybe during the middle of a sort of economic cycle, during the sort of middle of the good times, and the idea would be maybe to sort of, if we've just say come out of a recession, if we do get into some hard times over the next year, when things drop, I would sort of lean reasonably heavily on the mid caps and sort of towards the small cap value, and a bit less on the sort of S&P 500, say. And as we sort of start to come out, sort of in theory, the mid caps and small caps would do doing well those couple of years. And then as we start to get sort of towards the middle of the cycle, you'd maybe sort of even it out to this sort of 10%, 7.5, 7.5. And then if it's sort of been 6, 7, 8 years since the last recession, say, you'd maybe sort of lean more towards the larger caps, sort of towards the S&P 500, as they seem to be sort of more, looking back at past recessions, the large caps are a little bit more robust. they would fall less in the sort of crashes. So yeah, that's basically the way I'd be looking to play the US. So then I've got the iShares. This is iShares Emerging Markets, and the IMI is the Investable Market Index. So this is basically sort of a large, small, and mid cap emerging market index. They don't seem to sort of split it down, at least on Trading 212, into this type of 3 ETF format. So I just go with one large fund for the whole thing. Even the large cap emerging markets sort of aren't particularly huge, other than sort of the very top. That would be sort of the Chinese tech stocks. But quite happy having just one fund for the total market. And I've got that as 20%, sort of quite bullish on emerging markets. Going forward, I think the US have sort of had a good time of it over the last decade, and emerging markets should start to do well. So then Europe, I've sort of taken out all of the UK specific ones in favour of one sort of large Europe mid-cap. So I'm not a huge fan of the sort of top-end companies in the FTSE 100. Tend to sort of prefer the FTSE 250 and maybe the sort of lower end of the FTSE 100. So this sort of Europe mid-cap gives basically the sort of smaller of the large companies in the UK and the sort of mid-sized companies in the FTSE 250, and then sort of similar thing across Europe. So you have 10% of that. Similar principle to the US side, really, and then a Europe small cap value, again on similar sort of principle to the US. So I would sort of flip between percentages on this. Again, this would maybe be sort of a mid-cycle percentage, and again maybe sort of lean more towards the small caps if we have a bit of a crash. So then gone for a world small cap. So this just gives you basically the small caps across the world. It is a little bit of overlap with sort of the emerging markets, US and Europe, but also gives you some other countries, and just sort of it's an easier way to get the small caps in countries that aren't covered by these, basically, and it gives more exposure. Obviously, things like the emerging markets index is going to be heavily weighted towards large caps, sort of your Chinese Alibaba and Tencent and that sort of thing. So this will give good exposure to the smaller caps in things like emerging markets. And so then gone for a Japan. Again, I did sort of have in the previous one the Vanguard Japan, but this one is the IMI, the Investable Market Index. So it's large, medium and small caps in Japan, and yeah, gone for that at sort of 7%. Seems to be roughly about what Japan is, and yeah, that should do well. It'd sort of probably keep that fairly constant, and sort of rebalance maybe once a year or once every 6 months. Just see how that goes. And then I've got a few sort of industry specific ones. The iShares Global Clean Energy. It's a little bit expensive at the moment, but I think sort of just having it at 5% long term, it's got to be the way to go. So I think you just have to pay the price, really. If we have a bit of a crash, then expect this will come down pretty hard, and you just have to sort of rebalance things and buy into that at a bit more of a low. But as I say, I think that's sort of the way to go forwards. The VanEck Video Gaming ETF, again, is sort of heavy valuations at the moment, but again, I think it's a sector that should do well over the years. If it does have a downturn, then that would be the time to sort of invest low, and then should sort of reap the benefits of that over the years. And the iShares Global Water, a little bit more sort of a stable one. Does seem to be a bit of a problem sort of going forwards with water, so a lot of these companies are sort of trying to innovate and find new ways to sort of sanitize water and that sort of thing, various solutions. And yeah, seems to be a good steady one going forward. Get a little bit of dividend, maybe not quite as much as I would like, but it will be one might have to sort of sell shares for and rebalance if it goes above 5%. But I think that should do quite well. And I think in the last time I had the iShares Gold Producers ETF, which I've had in the ISA in the past. I've got rid of that now, but longer term I sort of wanted to have a bit of gold exposure in there. But recently Trading 212 have added the VanEck Gold's GDX and GDXJ. So again, sort of in a similar vein to the other stock side of things, the GDXJ sort of gives you more targeted exposure to the smaller miners. So if I'm going to have this as 5% in the portfolio for sort of longer term, you can switch between sort of the juniors and the larger caps depending on sort of where the gold price is. So if gold's taking a bit of a hammering, then you'd want to be in the larger caps, and if we're in a bit of a downturn and gold price is starting to rocket up, then you can get into the more junior miners, and they sort of see a bigger upturn in the good times for gold. So yeah, that's going to be the sort of, well, pie, but as I say, I'm not really using the pies, but that's going to be my allocation. This will hopefully be half of the portfolio once I sort of move towards semi-retirement, with the other half being individual stocks. And I would sort of maybe have this just rebalance once every 6 months or a year, or obviously if I'll get dividends from these, then you can reinvest dividends sort of by allocation and just rebalance it a little like that. But yeah, so a little complicated, but I don't think it'll be too bad to sort of keep this in check in the longer term. So leave your thoughts in comments below, and drop a like if you appreciate it, and subscribe if you want to see more. See you soon.